Good morning, everyone, and thank you very much for joining me. This is the DAX Open. My name is Russell Shaw, Senior Market Specialist at FXCM, and my email address rshaw@fxcm.com. Today's Friday, the 25th of February, 2022. I just want to let you know from next week, we're actually going to change the name of this webinar. We're going to call it the Morning Review. So we'll start off with the DAX, but it will be broader than just the DAX. So we're going to change it to the Morning Review from Monday. Let me just bring up the high risk investment warning. I'll keep this on screen for a few moments. And here's our market commentaries disclaimer. And here's our references. Hey Anna, morning to you. Nice to have you on the webinar. I know I've got to reply to your email. I'll do that today. All right, let's bring up the chart. We'll start off with the DAX, but I think we need to just go through the morning note from CNBC, as I think the news is particularly sensitive at the moment in terms of markets, and just generally. Europe markets set to open higher as investors closely monitor Russia-Ukraine crisis. European stocks on Friday are set to open higher, tracking gains in Asia as market participants assess the impact of Western sanctions against Russia after the Kremlin launched an invasion of Ukraine. Russia on Thursday launched an attack on Ukraine via land, air, and sea, prompting fears of a devastating humanitarian crisis and sending shockwaves through financial markets. Ukraine's Foreign Minister Dmytro Kuleba said the capital of Kyiv was hit with horrific Russian rocket strikes early Friday morning, with several reports of explosions being heard around the city. The crisis in Ukraine is changing rapidly, and specific reports from the country are difficult to confirm. Ukraine's President Volodymyr Zelensky said in a statement that at least 137 people have been killed and 316 have been injured during the invasion. Zelensky, who has remained in Kiev, later warned of enemy sabotage groups entering the capital. US and Western allies have condemned Russia's assault, coordinating a squeeze on Moscow by implementing a sanctions package designed to limit international trade with Russia and target banks and oligarchs. Ukraine's Kuleba angrily called an even tougher international measure to deter Russia, specifically blocking Moscow from SWIFT, which is a payment system through which it receives foreign currency. So if you're going to send a bank transfer, I'm sure you're all aware you do it through the SWIFT system, if it's going internationally. Global stocks on Thursday sold off sharply on news of the attack, although US stocks embarked on a stunning recovery to end the session in positive territory. In Asia Pacific, shares mostly rose on Friday, with Japan's Nikkei 225 up almost 2%. Elsewhere in South Korea, the Kospi rose 1%, and the ASX 200 in Australia edged up 0.1%. The Shanghai Composite added 0.54%, and the Shenzhen component jumped 1.08%. Hong Kong's Hang Seng declined 0.14%. All right, so let's take a look at the DAX, and then I'll throw out. I'm not sure I'd call it a potential conspiracy theory, but it's just something that I kind of have been thinking about. You guys, of course, can give me your opinions, but the market rhythm here, we still got to be aware of it. So we're starting on the hourly. 1, 2, 2, 3. 1, 2, 2, 3. Okay, we're still within this market rhythm. I think let's take this out. And we want to see if this is going to cross over. So do we get a bearish cross here? And if we get a bearish cross with the moving averages, does the stochastic drop out of the 80 area and start moving downwards? That would be the sort of the heartbeat of the current trend. The market note is suggesting perhaps a bounce. In order for that, I think, to be accurate, of course, we need to keep an eye on the stochastic. As long as it maintains the upper quintile, which is 80 and above, yes, then I think there is some positive momentum that's manifesting, and that potentially leads Europe, and in this case the DAX, up following the Asian session. If we just go to the daily chart, you can see we're still in a fair amount of difficulty here, aren't we? Let's maybe go to this chart, and just move it to a daily, just to take a look at it from a just a candlestick point of view. Let's keep the RSI in, just to see what its reading is on the daily. Okay, so this is an astounding candle over here, which is yesterday's candle. So let's just understand it, referencing this one in particular. So we've got a hammer there, right? That's a hammer which is generally regarded as a bullish candlestick pattern, but let's just understand the sentiment. So this is Wednesday's close here. Okay, this is Wednesday's close, and then there's a gap down. It gaps down to open. This is Thursday's open. So let's just assume that it opens over here, and this open over here would be off of a gap down. Why would it gap down? Well, that is the fear, the risk of fear emotion coming, to the surface, where whoever was holding at this level at close, well, as soon as news of the invasion emerges, they want to get out at any price, so it gaps down, and then what happens is there's a big, huge sell-off. Okay, so we've got complete bearish action until this point. We've got a gap down, then we've got bears moving price down in a fairly emotional sell-off, and then what happens is the bears lose control to the bulls. The bulls actually come in late in the US session, and the price closes well off its low. Okay, so there does seem to be perhaps some support here. Now, one day doesn't make a trend. We still, I think, got to understand we're operating in an uncertain environment, and that to me is the key. Uncertainty equals risk. So the higher the uncertainty, the higher the risk. So I think we're still in a high risk environment here. The bulls will have to follow through today to make yesterday's candle action count. Okay, if we just take a look at the S&P, take a look at the S&P, you can see it actually closes up. So the bears lose absolute control here, and the bulls actually take control away, and it closes up. A remarkable session on the US markets yesterday, really remarkable. But again, I would suggest, are these real moves? In other words, will we see follow through? And I think we just need to keep an eye on that, because uncertainty doesn't mean it will necessarily fall in price. Of course, price can go up, but we don't know. It's uncertain, right? At the moment, we've got a red candle down. This is actually again a slight gap open here. Okay. Let's just take a look at the weekly chart. We looked at it in terms of the moving averages yesterday. So we've got the angle and separation here. So it's not a comfortable position to be in at all. This does look like there is a potential for capital erosion here. If we go back to this chart, I'm going to go to the weekly. I want to just show you guys something. Right, so we're going to go to the weekly, and what we'll do is we'll put in the labels as follows. I'm actually going to start over here. Okay, so then we've got the peak, then we've got the trough, then we've got the lower peak over here, right, and then we've got a lower trough here. So there's already a bear market going back to the 22nd, the week of the 22nd, and then we've got the next lower peak here, and then we've got a lower trough here. So this is this is a downtrend in terms of definition. In other words, this could be looked at as a bear market until proven otherwise. The peak and trough analysis, yes, is really giving us a real warning. Now, I don't know how far this bear market goes. We might have some support here. Remember, we're not trying to predict, we're not trying to forecast, but we're trying to see what the charts are telling us, and we must acknowledge the definition here of a lower peak followed by a lower trough. In fact, a series of lower peaks, lower troughs. And of course, we've got the moving averages really showing that angle separation. Now, I looked at the S&P yesterday. It's not coming up. Where's my S&P? Okay, let's just give it a few moments. There we go. That gave me a bit of a nervous start to the morning. All right, just take a look at it over here. So now we're looking at the American main index, the S&P 500. So this is the large cap, and we put our labels in, right? Peak, trough, okay, lower peak, and this week's price action has put us into bear trend. Okay, so the way that the markets define bear market, the way the official definition of a bear market is 20% down. I don't know if that's sort of an accurate representation. My preference is peak and trough analysis, just as a technical analyst, and this is in my opinion, a bear market, lower peak, lower trough. If we go to NASDAQ, which I haven't examined the peaks and troughs in the NASDAQ, so I'm not sure what to expect here, but we're going to do a similar exercise. And what we'll do is we'll put in a peak over here. We'll put in the trough over there, and I think you guys can already see it. Peak, trough, okay, lower peak, and then of course we've got the lower trough. Let's take a look at the the Russell 2000, that small companies index. Let's see what they're doing. Okay, so we've got a similar story here. This is the most bearish of them all, it looks. Excuse me. Peak, trough. We've got a lower peak. We've got a lower trough here. So there's the bear trend defined. Let's see if we've got a series of lower peaks and lower troughs. Let's just see. We might not. Yes, we do. So because this candle's low is lower than this lower trough, so we actually got a series of lower peaks, lower troughs. So the small companies is really looking in poor shape. Now these are peaks and troughs on the weekly time frame. This is what we're doing to try and assess primary trend, which is theoretically reflective of underlying fundamentals. So we've gone now from the DAX, and we've seen the US markets. Let's take a look at the FTSE. So let's take a look at the 100. Again, it's one that I've looked at, so we'll do it together. The FTSE looks slightly more resilient. Okay, the FTSE looks slightly more resilient, and that's possibly because of the makeup of the FTSE 100 in terms of commodities and oil. Royal Dutch Shell is a huge part of the FTSE 100, so that's just something that comes to mind. But we don't have an uptrend in the FTSE, but we don't have a downtrend either. Why don't we have an uptrend? So the uptrend would be like this: 1, 2, 2, 3, 1, 2. So there's the uptrend. So this is the uptrend because we've got a higher trough, higher peak, but now we've got a lower trough. So that lower trough has effectively ended the definition of the uptrend. If we get something like this, the FTSE goes into bear market territory. So out of all of them that we have examined this morning, the FTSE is holding up the best. Let's just do a general, let's go through to symbols here. And let's take out, we've looked at the NASDAQ, so let's just take out the NASDAQ. And let's put in Euro stocks. Okay, Euro stocks 50. Let's see what that looks like. All right, so the Euro stocks is in the bear market, and let's just. So the financial markets are looking quite fragile at the moment. Peak, trough. Here's our lower peak, and then really this week has really made a huge impression on global markets. Here's the lower trough. So in my opinion, we've got very dangerous looking trends. Now, do they manifest into full-blown bear markets? I don't know. I don't think, you know, it's worth making the forecast. Again, I'll make a case for what I think could happen, but I'm going to just end the sentence subject to correction. If we go back to DAX, and we take out the RSI, and we put in a stochastic. All right, put in the stochastic, and this now becomes I think, a hugely influential, influential is not the right word, but a hugely informative indicator. Because if we go into the lower quintile, if we go into that 20 area and we hold, well, then the bear markets unfold. So if we take a look at the US indexes, we take a look at the Euro stocks, we take a look at the DAX, and if they all go under 20 on the stochastic and hold that, then we're in for a whole lot of pain. Then the bear markets unfold, and it's so clearly we've got this big, huge candle here. This is the catalyst for this is the Russian invasion of Ukraine. However, the truth of the matter is, even before this week, we had a lower peak, lower trough. Even on the Russell, we had a lower peak, lower trough, even before this week. So the question is, well, why were there bearish patterns starting to emerge prior to the Russian invasion? And I think that's got everything to do with monetary policy. Yeah, so okay, so Pete's saying it's better to take the dog for a walk until everything settles down. Yeah, in my case, Pete, it's better to take out the fishing rod and come back after, right? But I hear what you're saying. Yeah, the daily stochastic is getting to really dangerous territory now. By the way, Pete, that 20, that's my line in the sand. Somebody else may be using 30, right? So anything under 30 in somebody else's system might be. So you're quite right. I mean, it's looking quite weak. We must. What I want to say is we don't want to get caught in the fact that we're in a sort of irreversible bear market, because I don't know if that's the case, and I would tend to probably think that's not the case. I would probably tend to think now's the time we should be monitoring for opportunities. We should be not allocating capital to long-term positions, but hunting for potential times to allocate. Because the truth of the matter is, indexes will oscillate between bull and bear markets. We know that. But at its core, indexes are assets. Okay, some companies go bankrupt, fine, but the way, just to talk about the S&P 500, the S&P 500, the way it's actually built, the way it's put together, it's built by what's called market capitalization. I think the DAX is as well. They're actually momentum indexes. So any poor companies would fall out of those indexes. So we've generally got good companies in these indexes, meaning that they are assets. Now, what's the definition of an asset? An asset, the definition of an asset is something that's going to give you economic benefit in the well, let me rephrase it. What's the definition of a financial asset? It's something that's going to give us economic benefit in the future. So these companies at some stage are going to represent really good value. At some stage they are going to represent good value, but we must be cautious at the moment. The sentiment is bearish. It looks to me as if we're in a bear market. So that being the case, it's kind of, if you've got long-term holdings, take a look at them, see how you want to manage them. If you are wanting to exploit dips, sure, maybe we want to just catch, maybe we want to just wait for it to bottom and move in after the fact. So that's my sort of view at the moment. The key is to keep an eye on that stochastic. That's the momentum. Now, I want to throw out a potential, I'll call it a conspiracy theory, but I think it makes a whole lot of sense. So let me bring up my paint. So do you guys remember as COVID hit? So if we go back to say March 2020, sort of February, I'd say towards the middle of Feb, towards the middle end of Feb 2020. You guys remember the oil price war? You guys remember that? So Saudi and Russia went to war. They had a price war, and the price war was I think the Saudis wanted to increase oil production. The Russians were against that, and then the Saudis went and really kind of turned on the taps, and oil tanked just at the time that COVID hit, and it was like almost a perfect storm, prompting a huge sort of risk-off event, and we all know what happened after that. So the question is why was Russia against turning up production? I mean, there could be a whole host of reasons. I'm just going to give you sort of a conspiracy theory. So let's fast forward now to say the last quarter 2021, and at this stage, when I say the last quarter, I'm talking about maybe even the last month. The last month, 2021, first month, 2022, Fed retires the word transitory in reference to inflation, right? Okay. Now, so at this stage of the game, it's clear that we've got persistent inflation. Okay, it's clear that we've got persistent inflation. So let's take a look at this just in terms of basic economic 101 models. And what we'll do is we'll do inflation. Okay, if you look at this, you'll never see the y-axis labeled as inflation. You'll see it labeled as price, but just not to confuse the issue, let's just label it as inflation. And we're going to call this GDP, which is the gross domestic product of a country. And every country's got what we call potential. There is a limit that a country can produce. Okay, so every country's got a potential level. You can potentially go past it, but you can only go past it for very short-term periods because then it just overheats. And there are automatic stabilizers which would push it back down. And then, sorry, let's just to what we're going to call potential the full employment level. We'll call it full employment. Okay. And I think we can agree that we're pretty close to full employment by the narrow definition, the U3 definition of employment. And let's just say this was the aggregate demand, and this is aggregate supply. Okay. All right, and COVID hits, takes us way off of potential, and this is our starting point. Okay, so this is our starting point. So now the world's got to respond, and we'll just use the US here as a proxy for general economic reactions, because I think they're fairly consistent throughout. So what happened was the central banks started increasing liquidity, and that means there was a whole lot more money generally floating around. It also meant interest rates came down. Lower interest rates, more money means that we've got more capacity to shift demand from a multiple of levels. The aggregate demand's made up from let's just make this as clear as possible. Aggregate demand is made up of government spending. It's made up of private investment. It's made up of consumption. Consumption's huge. It's about 70% of GDP. And it's made up of, we'll just call it net exports. Okay. Now, so just working with the first three. So we know that the Biden administration really put a huge emphasis on infrastructure spending, fiscal policy. So that's G moving up. With interest rates coming down, business investment potentially becomes cheaper. Consumer spending becomes cheaper on our credit cards, etc. So we get a whole lot of shifts up. Okay, a whole lot of shifts up until we kind of head back into full employment. Okay, back to potential. So I think, and we're pretty close, let's say, to potential now. So we'll call this AD1. So we've moved from AD to AD1. What's the net effect here? The net effect is we've got rampant inflation. Okay, so this is the problem. We've got rampant inflation. Okay, because we've moved up. We've moved up to there. But at the same time, we've got a whole lot of growth in terms of GDP. So now the central bank is trying to control the demand side, okay, and starting to take that liquidity out to try and offset some of this inflation. So maybe we get sort of a pullback to here. Let's just say, and let's just say we're pretty close to full employment here. We can live with this on an economic level. The central banks can live with, because we've still got a pretty good, we're pretty close to potential, and our interest rates and our inflation has come down. And that's a job well done. That's what the central banks are trying to do. Okay, that's why they're trying to raise rates. Now, this is now the conspiracy theory. Okay, the conspiracy theory is, well, Putin knows that the policymakers want to get from AD red to AD purple. Okay, and the way that policymakers can do that is they work on the demand side of the economic model, and they do that by either pulling back on fiscal policy, or they do that by increasing interest rates on the monetary side. In other words, a contractionary fiscal or a contractionary monetary. Now, Russia attacks Ukraine. So the question is, well, what's the West's response? Okay, what are the possible responses? Okay, so the first thing is, the first response was something called Article 4, which is Article 4 of the NATO treaty, right? Of NATO treaty, and that is basically members. A member can trigger Article 4 when they feel that there is some sort of aggression that's going on that's threatening their particular border. So once Article 4 is triggered, it's effectively calling a meeting, a consultation of NATO members. And then the idea here is deterrence. So one of the ways would be to increase defense budget, for example. So the NATO, and that's generally how Article 4 was sort of a very big sort of deterrent during the Cold War, right? The next part of that, then there's Article 5, which Article 5 is basically if you attack one of our members, it's as if you've attacked all of our members. So at the moment, Article 5 cannot be triggered because Ukraine's not part of NATO. But as of yesterday, Estonia, I think Latvia, Lithuania, Poland had triggered Article 4. But Article 5 can't be triggered until a member state is attacked. So in terms of responses, Article 5 is not going to be triggered. So there's no real sort of, I don't think there's any possibility of like a response from there. One would think, never say never, right? So that's so what's the other possibility? What's the other possible response? Sanctions. Okay, but this is the genius of the timing of this attack. How effective can you be with your sanctions here? And the truth of the matter is not very effective because of the problem of inflation. You see, I just researched Germany, which is the biggest economy in Europe. Well, they get 35% oil, 50% coal, 55% natural gas from Russia, and that's in a tight market already. We've got the huge supply issues in the resource market. So now, if you start sanctioning exports, specifically the commodity exports from Russia, you make a tight market tighter. The influence isn't on the demand side. It's now you're starting to price raw materials higher. Starting to price raw material higher. Okay. Now let's change this to blue. Okay. Another country adds sanctions. So now you're moving your aggregate supply curve out. Now remember, you want to get from 80, if you're a central bank, you want to get from 81 to 82, so from red aggregate demand to purple aggregate demand. Now, if sanctions are imposed, well, the aggregate supply curve starts moving. So all of a sudden, your GDP starts shrinking. And not only does your GDP start shrinking, inflation starts moving higher again. Okay, and that's out of your control because the policymakers control the demand side. They're completely impotent when it comes to controlling policymakers are completely impotent in controlling inflation on the supply side. Okay, and there's a name for this. There's a name for this. Okay, and that name is, so you all know it, stagflation. Stagflation is interest, higher inflation and lower growth. Now, that's the worst case for a incumbent government because there's nothing they can do. They can try and move aggregate demand up again. Okay, but then they've just increased inflation even more. So now you're fighting. So you've increased GDP slightly, but you now are going into an inflationary spiral. Okay, so you can't fight stagflation, and I think that's the genius of the timing of this attack, because I would expect President Putin understands, the economics of the situation, to the point that there's already reports out that the West is imposing sanctions, but they're not going to do it to the point that's going to disrupt their own economy. All right. So if you're sort of being out of work because of COVID, and now we are in a recovery and we're moving towards full employment, okay, but all of a sudden the sanctions start causing stagflation. So now, if you're a business, okay, there's not much you can do about the price of raw materials. You can't control those costs, but you can control your variable costs. So, in other words, to compensate for the erosion in margins, you start laying off workers so that you can grow your margins again. So there is a situation where a lot of people are now returning to work, thank goodness. But if you start imposing sanctions that push commodity prices up to a point that the supply side is now causing stagflation, higher inflation, lower GDP, well, you're going to get laid off. And that's the quickest way to get voted out of office. Okay. Policymakers cannot deal with stagflation. They want to avoid it at all costs. Okay. And that, I think, is the genius of the timing of this invasion. There's not much the West can do here. Okay, Article 5 is not going to be triggered. Okay, and sanctions are going to be very localized, very concentrated, not broad, because of the danger of stagflation. And if there's any questions, please go ahead. And if there's any questions, you can go ahead and type those in. Tell me if you disagree with that, or if you think I'm off base. But I was giving this some serious thought, and the timing is uncanny. The timing of this is uncanny. All right, nothing coming in. So let's conclude at this point, and we shall chat again. No, you won't have to re-register for the new webinar, but we're probably only going to have the morning webinars from now on, and then we're going to have the cryptos on a Wednesday, just to give you a heads up. And then that's what I want to do as much as we can in the morning webinars. All right, guys, thank you very much, and we shall chat soon. Thanks very much.